This is Carolyn from Twitter, KiwiTrader24. I also run a private account, Kiwi24 Carolyn, and if you would like to join that, if you like what you see in this video, you can click the link in my profile and it'll take you to GoFundMe and you can read a full story on how that account works and what I do over there. So let's take a look at the S&P 500 as we get ready to trade September week 4. We have a full week of trading, and everything that happens this week will settle in September and Q3. As of Friday, we have twice, 2 weeks in a row, closed below the halfway back for the quarter for Q3, the range running from our all-time high 35.88 to the July low at 31.01. Divide those two, add those two together and divide by 2, you get this 33.44 number. We also closed the week below the 50-day simple moving average. We haven't seen a move like that in a long time. We have our 10-day simple moving average barreling towards the 50-day. They will meet on Monday and they will bearish cross on Tuesday. And unless the market makes a bold move of a gap up open and rally to start this week, that bearish cross is going to pull through, and I'm going to show you the last time that happened. We have a gap above us that we left between Wednesday's close after the Fed statement came out and after Powell's press conference. We kept way down open on Thursday, tried to rally back to fill that gap, but we got stopped dead cold below the 10-day simple moving average, and then Friday gapped down and traded down below the 50-day and nearly tripled, more than tripled, nearly quadrupled the range on the day down upon loss of that 50-day. We wound up going bearish engulfing on the week by trading below last Friday's low, but we dipped our toe well down below 3,300, down to a low at 32.9240, and that puts us at 8.25% off of the all-time high. We reversed and came back to close above the previous week's low, but if the bulls really wanted to make a statement, they should have brought us back up to close at least above the 50-day simple moving average and above our halfway back for the quarter. But they didn't. They just left us here to rot down at this no man's land down here. We have one more gap. Let me show you. Bring back that chart real quick. We have one more gap below us that fills up between the August low and the July close. But here's the thing, and I will show you at the end of this video, that we will go into a bearish engulfing state on the monthly time frame if we even so much as dip our toe into this gap. Taking a look at that 10, 50-day simple moving average cross that I mentioned, here's the last time that that happened. Here was a cross down through the 20-day, which we have been trying to fight against this past week that we just traded, and then we crossed down through the 50-day. And what happened as this was approaching, we gapped down and we sold off way lower. This was our whole sell-off that led us into the March and 2020 low. So we've got that coming our way. If we fill this gap in between the August low and the July close, we're going to go bearish engulfing on the monthly time frame, and we're probably going to be looking at a move much lower. Since we are already below the halfway back point for the quarter, we might as well test the low end of that quarterly range at 31.01, and that would get us all the way back down here, and look what's coming up right here above the low for the quarter. That's the 200-day simple moving average. So if we're going to hang out below the 50-day, if we're going to see this bearish cross at the 10-day down through the 50-day, we're probably going to be heading much closer to the 200-day, if not all the way down there for a kiss and a reverse possibly in there. Along the way, if we dip our toe below 3,200, we get to 31.90, we will be at 11% off the all-time high. The all-time high itself was almost a perfect 11% up on the year. 35.86 was plus 11% on the year. We got to 35.88 and rolled over. So if this is just going to be a move where we just look below 3,200, it's because we're matching symmetrically that move that we made up at the all-time high. And we'll come down 11% and we'll reverse somewhere in the 31.90s. If we go a little bit deeper, we come down here to 31.51. This level really rhymes back here with what happened in June, where we gapped down open after the Fed meeting. Sounds familiar, doesn't it? That's what happened here this past week. And we sold off down and broke down to the 200-day simple moving average. Now at the time, the 200-day was above the 50-day, so it's going to be a lot more bearish this time than it was back then. But after that, we could not rise and close for the life of us above 31.51. So if all we're going to do is come down here and dip down below 3,200 and maybe reverse above 3,151, that's another scenario that could play out. But if we go the full distance of testing the low for the quarter, we've got the 200-day as well, we would make that full move there. And finally, let me show you the monthly chart. By simply getting below the August low and trying to fill this final gap here to the July close, we would go bearish engulfing on the monthly time frame. This is what happened the last time that took place. That was in February, right where we had the last time a 10 50-day simple moving average bearish cross. And the time before that it happened was in August of 2019. And remember that nasty sell-off that we had in August. And before that, it was in May of 2019. And before that, we had back-to-back bearish engulfing monthly time frames at the end of 2018. And you remember that we had a nasty sell-off in October. We tried to recover in November into the midterm elections. And then we went bearish engulfing again in December. So we are set up very similar to all of those events here as we head into the end of September. Okay, that's it. I hope this video helped you out. As once again, if you'd like to take a look at what I offer at my private account, just click the link in my profile. As always, good luck and good trading.